Welcome everybody to the fourth quarter and full year 2016 performance report. So this is always my favorite time of year when we get to tally up the final results and compare it all to the various benchmarks, see who had the good year, see who maybe didn't do so well. It's always a good time for me. So one thing I will say though, there's nothing particularly special about a January to December period of time. Of course, the markets don't know whether it's December or June or September. It's all the same to the markets. But this is the way it's done, so we're going to go ahead and conform to that. But it is important to note that this is just a single year of results. And of course, we are focused on the long term, multi-decade long returns, consistent, smoothed out, no drawdowns. All of those things still apply. We're certainly not going to try to draw any conclusions based on one single year. But the results have to be posted, so we're going to go ahead and go through those. The best way to do it is just to go through each one of my strategies on their own. We have 3 here. And then at the end, we're going to talk about how they combine and to make it the total portfolio solution and what that's going to mean going forward 2017 and beyond. So let's get into those results right away. So just quickly to give a little context here of the broad markets, this is the S&P 500 for the full year 2016. And, aside from a couple of down months early on in January and February, it was a very strong year. Now you recall, this was actually the worst calendar start for the S&P calendar year start for the S&P 500 ever on record. So right out of the gates, it was down. And it was feeling a little bit scary there for a while, but starting around March, the last 9 months has been a pretty steady, consistent climb upwards. There were a few bumps and bruises along the way. This is the Brexit vote. That was a little bit surprising, and there were certainly some very huge VIX spikes during that 2-day period. But markets recovered quite quickly, shook that one off. Here's the election here. As expected, of course, as you lead into the election, there's a lot of uncertainty. But again, once Trump was elected and it was solidified that he was going to be the next president, markets quickly rebounded, and it's been a pretty solid 9 months. So overall, including dividends, the S&P 500 was up 12% this year. Clearly, the bull market is still alive and well. Now, if you go onto the website under the 20 charts, of course, there's plenty of charts here, a lot of interesting ones. But we can see that this bull market is now at 94 months and counting. So the third longest in history, fast approaching number 2. We'll keep this updated every month and we'll see how far along we can go. Obviously, we know this is going to end at some point, but trying to predict when that is pretty futile. So it could be 2 months, it could be 3 years. Nobody really knows, but we will be keeping an eye on this number. Now, the S&P 500 made 12%, but the same, unfortunately, cannot be said for hedge funds. And I seem to be saying this every single year. And once again, hedge funds proved to be a wild underperformer. So December results aren't quite in yet. We'll just use November. It's going to be the same thing. Here's the last 36 months, 2.42% annualized. The last 5 years, 4.21. So during a very strong bull market, as we've seen in the last 5 years, hedge funds have just had an awfully difficult time matching their indexes. And this gets back to the heart of what I've been saying for many years now. The vast majority of investors out there would definitely be better off just investing their own money in index funds. Index funds have consistently beat fund managers, active fund managers, run-of-the-mill hedge fund or financial advisors, as well as hedge funds that are supposed to be the cream of the crop, the best of the best. We just see this year after year. So fortunately, this year we also saw the highest number of redemptions out of hedge funds. So the biggest amount of money ever was pulled out of these hedge funds, which is definitely progress. Of course, I can thank the internet for a large part of that, because with each passing year, more and more people are becoming aware of those statistics that show, 80 to 90% of active fund managers are underperforming their indexes. So, you wouldn't want to be investing money there. And more people are realizing this. So that's a good thing. But again, hedge funds have put in about 1/3 the returns of the S&P 500. So not exactly the cream of the crop there. Let's get into the actual performance for all 3 of the strategies now. So I'm just going to go through this performance right off of the website. Here's the 3 strategies, and then later on we'll talk about the total portfolio. But the first one is the VTS Tactical Volatility. Arguably the flagship strategy here because the returns are the highest among the 3, and it is the most exciting one. So for those of you who aren't aware, we are trading the XIV and the VXX. If you don't really know what this strategy is about, there's a video over here. I think it's about 13 or 14 minutes long, very short video, It describes all the input variables, how I built the strategy, talks about some results in there and what to expect going forward. So you can go ahead and check out that video, but let's get right into the results here. So over here on the right, 2016, you can see we made 67% this year for this strategy. Now that's a great year, but it's pretty much in line with the last 4, so nothing really stands out there. The only thing that I will draw attention to is that this year, for the XIV in particular, there were some drawdowns. There were some big down days in the XIV, the S&P, especially during that Brexit vote. There were some dangerous times to be in the XIV, and our strategy is always focused on risk management, preservation of capital, and smoothing out the returns over time. We're not looking for home runs here. We're not trying to make 100% return every year. We're just trying to make long-term consistent results over many decades. So we actually did reduce the drawdowns pretty substantially this year. Just that one mid-season is all we had. Aside from that, it was a pretty consistent, solid year. So bringing our annualized returns up to 80% compared to the S&P of just 13.5% over that same time period. Now, of course, I don't look at annualized returns very closely. I'm more interested in the Sharpe ratio, the Ulcer index. These are risk-adjusted measures. And you can see our Sharpe ratio is more than double. Ulcer index is extremely high. So our drawdowns are very few and far between. And when we do have drawdowns, they're very short-lived. We do recover them very quickly. That's why the Ulcer index is so high. But overall, here's the chart. And you can see we're off to new highs. And hopefully this will continue well into the future. But again, the most important part is the consistency of the returns. This isn't a really choppy chart. This is a very consistent upward sloping line, which I do like to see. So by far the most common question that I get asked is to compare my results to that of my competitors. Of course, I'm not the only person doing this. There are other websites and other subscriptions out there that people are researching. So this is a very valid question. Now, the problem, of course, is that over the internet, people tend to get pretty defensive. I'm certainly not looking to get into any online arguments or hurt anybody's feelings. So the best way to go about this is to keep it completely anonymous. I'm not going to mention any names. I'm not going to pull up anybody's website. But this is an important question to answer. Of course, this is a competitive business. And this isn't something that's abstract. There are actually right and wrong answers of which fund is better and which one is worse. So in order to answer this question, I'm not going to spend too much time here, but I'm going to pull up my own spreadsheet and we're going to get into some actual numbers here. So since 1 year of results doesn't really mean anything in the grand scheme of things, I'm going to use 4 years, the last 4 years of results. This is 2013, 14, 15, and 2016. Down here, of course, I'm not going to say the name. I'm going to keep this anonymous. Just call it major competitor. Now, the reason I chose this one, of course, I know who all my competitors are. I keep very close tabs on them. It's just good business to know that. And it's also a very competitive business. So, that's important. But the reason that I chose this one is I just feel like it's the best competitor, not only in they have the best results of all the ones that I'm comparing against, but we've also been trading a very similar time frame, just over 4 years for both of us. And, as far as searchability and, availability out in the, if you were doing your web searches, it's very similar to mine as well. So very, very good competitor for me to keep track of. So here's the numbers. Now, annualized returns, again, don't really mean much of anything. I am consistently saying that. But as far as returns go, we are substantially higher. The most important things to look at are these two. The Sharpe ratio. This is that risk-adjusted measure of returns. It takes into account the month-to-month standard deviations of results. So if you have a strategy that's having very big wins and very big drawdowns along the way, it's going to show up in your Sharpe ratio. It's going to have a lower Sharpe ratio. The higher the number, the better. And it may not show up in annualized returns, but you certainly in your risk-adjusted measures, you're going to pay the price there. And as far as correlation to the S&P, this is, in my opinion, one of the most overlooked things in trading. People don't often pay attention to this, but it's very important. Now, most people watching this video, if you've been investing for a long period of time, you probably are aware that what ends up happening most of the time, you have 5 or 6 good years during bull markets. That's fairly easy to do when the markets are going up. But it's always interrupted by that 1 or 2 years of bear market where you really pay the price. If you're too correlated to the S&P, of course, you're going to go up and then down. You're going to have that good period, and then you're going to give some of those results back. So that's why I never want to be very highly correlated to the S&P. I'm trying to make good returns during both bull markets and bear markets. I don't want to be at the whim of what the markets are doing. On either side of it, I want to make more than the markets make during bull markets as well. So I don't want that correlation to be high, and ours is very low. So as far as, raw numbers, this is something that it's pretty obvious. Like I said, there are right and wrong answers here. And if you look at a chart, it becomes even more clear why there's underperformance here. Whereas my strategy is more consistent. We're not really swinging for the fences here. We're just trying to be consistent over time. It's a nice, even sloping line. But with the XIV, the underlying symbol, as well as the competitor, it's way too choppy. And, there's definitely periods of good performance. Early on, there's a good period. That's a nice run there. 2016 was good results for both of them. Unfortunately, there's way too many drawdowns along the way, and there's way too many negative months that are pulling down those long-term results. So you end up kind of spinning your wheels. And this is during a bull market. So, of course, you have to expect that when things start to get a little bit troublesome, that this will be even more pronounced. Now, that's it for the comparison of this competitor. But now what I want to do is go beyond that and actually sort of teach people how they can determine whether a strategy is a bull market strategy or it is a robust strategy that is expected to continue getting good performance. One of the best ways that you can do this, you plot the numbers on a curve just like this, and then these are all the numbers, month-to-month numbers. What you want to do is you want to eliminate the best month in each year. So this 30% will now be gone. 2014, 2015, 2016. And then we're going to reduce one of the biggest drawdowns. So we've eliminated 4 of the best months and only 1 of the worst month. We're going to do this again to the index, of course, because that's what we care about, is comparing to an index. I'm no longer really comparing to the competitor there. I'm going to do it for the competitor as well. And then we're going to do it again here just so you can see it. This is the competitor's results. We're going to eliminate 4 of their best months and only 1 of their biggest drawdown. Now, the reason I'm doing this is what you would like to see is you would like to see this not wildly affect the results. You want to know that the strategy, when you eliminate 4 of the best months over a 4-year period, that you're not dramatically changing the shape of the curve. You want it to be consistent. That's what's going to keep the strategy going over time. Certainly big months help, but those are very few and far between, and you certainly don't want a strategy to be dependent on having just a few home runs along the way. So when we look at the curve again, it becomes pretty clear. The XIV, which is the underlying symbol, clearly is the result. That performance of the XIV, the 29.5%, was pretty clearly the result of 4 or 5 really good months, because the XIV is very choppy. It's having a difficult time even breaking even. It didn't even break even until 6 months ago. And the competitor as well, same story. Those returns, that 42.7, it sounds good, but remember the Sharpe ratio is very poor. And if you see in the chart, I've only eliminated 5 months out of 48, and it's already underperforming the XIV. So again, the competitor's results, while they look impressive at the beginning, when you're just scrolling through the numbers, it looks great. And you check those annualized returns and 42.7, it all looks fantastic. But in the end, it actually is just the result of a few good months along the way. There's far too many drawdowns to make this consistent over time. So if you're ever comparing results, and I'm, again, just not mine compared to theirs or anything, if you just want to know in general how you're able to determine something is a bull market strategy or not, start eliminating some of those best months, and you will very quickly see how dependent the strategy is on those big risk-taking months. So it wouldn't be a performance report by me unless I tried to slip in some type of golf analogy. So this is the best one I've got. As many of you know, I used to be a professional golfer. For about 5 years, I played pro golf. Gave it a shot, didn't really work out, moved on to bigger and better things. But as an amateur golfer, I actually won a lot of golf tournaments, probably about 40 tournaments over a 6 or 7 year period. I quite regularly won the tournaments that I was playing. A typical golf tournament has about 150 players, give or take. Now, if you were to ask me on any given day, if I play well, how many of those players could still beat me, could potentially still beat me? I'd probably say about a third of the field, maybe 50 people, could still beat me if I played well on one day. After 2 days, maybe only half that, maybe only 25. After 3 days, because a golf tournament's 4 days long, by the end of the third day, there's probably only, 8 or 10 of them that really have a chance. And at the end of the fourth round, probably just a handful, probably 2 or 3 people is really all we're looking at. Now, the same thing applies to investing. If you were to ask me how many people can beat me in an investing year in 1 year, I would say many. I mean, who knows? What's the number? It's probably a lot. 2 years? 3 years? After 4 years of annualized returns added together, we're not talking about very many people. So that's kind of where I'm going with this. And also, to take it a step further, if you were to ask me how many people could beat me if it was a nice, sunny, warm day, middle of the summer, fairly easy golf course, flags right in easy, accessible positions, how many people can beat me then? Again, probably quite a few. But if it's cold, it's raining, it's windy, very difficult golf course, very long golf course, super fast greens, how many people then? Nobody. Those are the tournaments that I would win. If I showed up and the conditions were extremely bad and the golf course was very long and hard, I was just smiling through the whole thing because I know that consistency over time is what I was best at. I'm certainly not the best player over an 18-hole period, but over a 72-hole tournament, especially if the weather conditions were awful, the worse the better for me, that's when I knew that I was going to win. So investing is kind of the same thing. I look at it with the exact same mindset that, look, I'm not trying to outperform people in 1 year. That, to me, that means absolutely nothing. The tournament has barely started. What I'm trying to do is outperform everybody else over a many-year period during many different market cycles. I want to do, during bull markets, obviously it's nice to perform well, but that's not good enough. We also have to do well during bear markets. We have to do well when the markets are chopping around sideways and not doing much of anything. So that's what my strategies are designed to do. The volatility strategy, as I just illustrated, it didn't do the best this year. 67%, pretty solid, but certainly not the best year we've had. We had a 78% last year. We had a 77% in 2013, but it was good. It was a very good year. Over a long period of time, that's when my confidence level in the strategy starts to skyrocket. I think that we're going to be the last man standing when the markets really start to show signs of weakness. So that's my best golf analogy. Sorry to anybody who's not a golfer, but I do tend to try to slip those in there. So, bear with me. So we're moving on now to my favorite strategy of the 3 that I have, which is the VTS Tactical Balance Strategy. Now, just as a reminder again, this is a strategy that trades stocks, bonds, and gold, traditional asset classes. And if you want to know more about this strategy and how I put it all together and how I trade it, again, there's a video here. It's just a short video on YouTube. It'll tell you everything you need to know about this strategy. Now, the reason that I say this is my favorite strategy is because trading traditional asset classes is actually very difficult. To get an annualized return like we have of 14%, when the S&P over the same time period is only 7.7, this is actually not that easy to do. The reason for that is because all of the asset classes that this strategy is trading, stocks, bonds, and gold, they don't actually go up that much. They don't achieve the rate of return that you would want if you're trying to get a good rate of return. And I'll show you in the 20 charts here. I'm just going to scroll down because I have it all listed here. Major asset class performance over the last 10 years. Look at these annualized return numbers. 7, 6, 8, 4.5. These are not exactly high rates of return for those individual asset classes. So it doesn't matter how you put them together into a portfolio, the best you're going to get is 8.09, and that's if you put 100% of your money in gold. Obviously, that's a terrible idea going forward. So you have to put combinations of these numbers together, and it's not going to lead to a very good rate of return. So what we can see, if you were to do 50% stocks, 25% bonds, and 25% gold, buy and hold, you just put it into a portfolio and held it, you would actually have outperformed the S&P 500 by, 1%, maybe 1%. You're basically tracking the S&P 500. Now the benefit is you're reducing those drawdowns. You're more diversified and you're reducing those drawdowns. But the reason I like the balance strategy so much is because we have been able to tactically move in and out of the MDY, IEF, and GLD. We only hold one of them at any given time, so that's why it's tactical. But we have essentially doubled the returns of the S&P and of the buy and hold strategy. This is not actually that easy to do. So that's why I say that this is my favorite strategy, because I feel like it's the one that demonstrates how a well put together strategy can actually perform over time. It is actually possible to trade traditional asset classes and get a very good rate of return. You're not subject to those same very low, 6, 7, 8% rate of return. There are smarter ways to trade it and get a better rate. So here's our 2016 results right here. You can see that for the year we made 21.7, which was a great year. Wasn't the best year, but it was a pretty good year. If you go back further than this, these are just results dragged back further, you can see when things really go off the rails, like 2008 leading into 2009, that's when we started trading gold. And then, of course, the rebound, thanks to stocks rebounding, you're going to get some pretty good rates of return. But the same thing kind of happened in 2016. Remember, early on in the year, the stock market kind of collapsed, started the year terribly. But because we were tactical and we were in gold and a little bit of bonds, we were actually able to make some money early on in this year. And then from March on, we basically just were, fortunate that the stock market went up and we're able to tactically allocate to stocks. That's how this strategy is working. It's bouncing in and out of the three major asset classes depending on the volatility signals. If we look at the individual allocations and how often we've held each one of these positions over the years, you can see why the strategy is working so well. So, of course, right off the bat, again, I have to say that I don't actually know what's going to happen tomorrow. Nobody does. I don't know what's going to happen tomorrow, 2 months from now, or 2 years from now. So the point of the strategy is to design something that is able to get indicators from the market, and so that we can make good decisions, even though we don't personally know what's going to happen, right? Market predictions are just as often wrong as they are right. So that's not the way to build a successful strategy. I'm getting signals from the volatility market that tell me when to move in and out of these positions. So in 2016, for example, we held stocks almost 73% of the time. It was a good year for stocks. From March until December, we pretty much held the stock market. I didn't know that ahead of time, of course. I didn't know that stocks were going to do that, but the volatility market did. And we didn't hold gold and bonds for very much of the latter half of the year. We held gold and bonds early in the year when stocks were collapsing, and we made some nice returns there. If you go back a little bit further, 2014, 2015, markets were more choppy. Their volatility was elevated. It was more uncertain. And again, the strategy moved away from the stock market a little more often and into the bonds and gold market more often. All right, that's the strategy working. 2012, 2013, of course, we know those were strong years for stocks. The strategy knew that ahead of time. Of course, I didn't. But the strategy moves into the right positions more often than not. If we go back to the financial crisis, that's when you can really see it, because that's a time that you definitely would not have been wanting to hold stocks. And the strategy knew that, and we didn't hold the stock market very often. But what we did do is move into bonds and gold. So the strategy knows kind of what to do most of the time. It's not going to be right all the time, but it's using those volatility signals to essentially double the rate of return of the markets. This is why I love the strategy so much, is because that level of outperformance is actually hard to do. Now, with the volatility strategy, for example, I'm not saying that's easy, but the underlying volatility market does move more. It's more aggressive, and you can actually see the XIV itself make 20 or 30 or 70% in any given year if it does really well. You're not going to see that with these underlying symbols. So this outperformance is actually really what we're chasing in the long run. We're looking for strategies that do well over any market environment. And that's what these results are showing, is that, as you can see with the annualized returns, there really was no financial crisis for us. There really was no European debt crisis. There was no flash crash, none of that stuff. So this is a strategy that I really believe strongly in going forward. And of course, I will continue to trade it, and I would invite everybody else out there to do the same. The third and final strategy here on the website is called the VTS Iron Condors. Now, for this strategy, because it is a derivative strategy, it is inherently more complicated for people. Now, the truth is it's actually pretty simple and straightforward, but because it is a derivative strategy, I wanted to hold off on doing any performance reporting on this one because I want to do more specific focused videos on this subject. So in the next couple of weeks, I'm going to do some Iron Condor videos and talk about the strategy, what its goals are, why it works so well, And of course, I want to talk about the times that it may not work so well, because not all trading strategies work in all market environments. We want to be open and honest about that. So I want to go into a lot more detail about iron condor trading, far more than I want to do in this performance report. So just really quickly, of course, you can see that it does achieve the same goals that I'm looking for in the other strategies. We want to outperform on an annualized return basis, but that's not good enough. We also want risk-adjusted metrics like the Sharpe ratio, the Ulcer index. We need these to be very high, and we need a low correlation to the stock market. And then, of course, a drawdown that is manageable. So, iron condors are a very successful strategy, and I'm really looking forward to making a more focused, specialized video explaining this one. So be on the lookout for that one on my YouTube channel. So the last thing we need to talk about is by far the most important part of this video, which is the total portfolio solution. Now, obviously, it's very nice to have individual strategies that perform well. That's always exciting to see the volatility strategy be up 67%. A lot of fun there, but what really matters and what we should only concern ourselves with is what happens to our entire net worth. What happened to our entire portfolio? That's what the total portfolio solution is. So this is just combining our three strategies: 25% in the volatility strategy, 25% in the iron condor strategy, and 50% in that traditional asset class tactical balance strategy. When we put all of this together, that's what really gets me excited, is what's happening with my entire net worth. Now, this year in 2016, we made 34%, and we did it in a very consistent fashion as well. We had one drawdown in June, which, of course, during that Brexit vote, the volatility strategy did lose a significant amount that month. But that's why we diversify, because it actually didn't have that much effect on our whole portfolio. So overall, just a very, very smooth year. Really not a whole lot of deviation from the returns that we were seeing from month to month. It was a very good year. Long-term annualized at 29.4, and we made 34. So we did actually outperform, but it's more or less in line. Now, again, the total portfolio solution, what makes it my focus and what makes it so important is, the annualized returns. Again, let's just ignore those. Let's look at the risk-adjusted returns. The Sharpe ratio is above 2. The Ulcer index is nearly 16, which really shows that the drawdowns that we're experiencing, they do happen. We do have occasional losing months from time to time, but they are very short-lived, and we are recovering from them very quickly. That's why you see such a high Ulcer index. And again, not correlated to the S&P 500 as strongly as most other things. Remember, hedge funds are about 90% correlated. Balanced index funds of stocks and bonds and even gold, they can be at 70, 80, 90% correlated. So correlations are very low. The only reason we're correlated is because both of them are going up, basically. But they're not actually, our results are not the product of the S&P 500 going up. So this is really the end result of all of the strategies put together. This is why we trade all three of them. Now, certainly you can subscribe to just one of the strategies. I make it available that you could do any one of them on their own individually, but certainly I would like people to be diversified and more safe, focusing on the long term. We're trying to be successful over a 20 or 30-year period, not just a couple of years here and there. So hopefully people understand the value of the total portfolio solution, and this is certainly where my money's at, and I would invite everybody else to consider the advantages of this diversified portfolio. So that's it. 2016 is officially in the books. I invite everybody to join me again for another very solid year in 2017. Also, thank you very much to everybody out there who's been giving me, a lot of compliments, a lot of encouragement this year. I used to do a lot of articles on my websites, and this year I really transitioned into doing a lot of videos. It's really not as easy as I thought it was going to be. So thank you very much for all the kind words. If you are not already on the newsletter, I'll leave a link here. You can sign up for the newsletter. You get the blog articles and videos sent to you as soon as I make them. And if you are ready to get on a more consistent path of investing success, reducing those drawdowns and getting a better rate of return through good markets, bad markets, and everything in between, I would encourage you to check out the website. There's tons of good stuff on there, articles and videos. I go into detail about all my strategies. If you are ready to subscribe, I'll leave a link there as well. You can go on the website. You get a free 2-week trial for signing up. So, no risk. You can try it out for 2 weeks. You can see what it's all about. You can get the email signals daily sent to you. And then after that, you can decide whether it suits your long-term investing goals. But thank you very much for watching, and I will see you next time.